Good morning, everyone. Hi, I am CA Digambar Pednekar. Thank you so much for giving me this opportunity to have a discussion on audit of banks, specifically advances. And thank you so much, each one of you, to take time out to attend this seminar. I really appreciate and congratulate WRC Chairman Mr. Lalit Bajaj, Regional Council Member Mr. Vimal Agarwal, Vasai Branch Chairman Ankit Rathi, Vice Chairman Abhishek Tiwari for giving me this opportunity to have a discussion on audit of advances and the documentation process. Before we start, let's understand basics of banks. What are the different products? What are the prudential norms? What are the IRAC? So today's topic, we're gonna cover three important aspects. One, the basics of bank audit of advances. Second, what are the prudential norms which are the key to audit of advances. And the third, the recent audit procedure to be performed in order to ensure the risk of the audit firm. So stay tuned with us and we'll start the session. Thank you so much. So before we start the audit of the bank, we need to understand what is the banking, what is the current banking scenario, how the changing environment has actually impacted the bank. If you actually look at the last decade, the banking was an institution rather than akin to the public utilities. Bank was assured to have a fixed spread over their cost of borrowing, and this is because the banking operation was so centralized, it was so regulated, there were huge entry barriers. But look at today, the banking has actually changed dramatically. I'll tell you why. Because of the huge financial reforms which has taken place recently, the IT reforms, the use of technology, sophistication of the customers, the banking regulation norms, the regulatory actually impacted the whole banking scenario in India. There are studies conducted on Indian economy. They have actually said the banking system is very resilient. Actually, they have withstood during a global turndown. The Indian market is quite capitalized and sufficient. But this theory doesn't hold good when you look at 2007 crisis, when the Lehman has crashed. I was watching an interview. They have clearly mentioned that when the Lehman crashed, the whole global economy was down. But the Indian credit was growing at the rate of 24% to 26%. The same interview, it was said that where the customers wanted, borrower wanted 100 crore, bank was giving 400 crores worth of loan, because when the one bank is growing at 24-26%, the other bank also wanted to grow at 26%. As a result, we have actually expanded, the borrower actually expanded their business than their requirements. They actually installed the capacity beyond the means. Borrower actually started borrowing overseas company. And the trend has come where the company, Indian company, started bidding the government contract at very competitive prices. And we still thought the Indian economy is resilient. But it did not go well. The first person to realize the Indian economy is not resilient is a promoter. And what they do once they realize that they take their money out. And what they do later, they actually start playing with the bank's money. They start borrowing more and more and more in order to repay the interest and EMI. I've seen a balance sheet where asset has actually grown 2 times, but the borrowing has actually grown 6 times. It goes on to say that the borrowers are playing with the banking system and they use this money to repay the interest. And the whole scam, it is not a scam, but the whole thing actually come out when Mr. Ragurajan decided to burst the bubble. And that's the genesis of today's banking system. So let's start today's topic. But before we discuss what is a best audit processes to be conducted, what are the SMA 1, 0, 1, 2, what is the CRILC report, what are the red flags account, what are the fraud account, what are the early warning system, what are the stress account, what are the low rated, what are the under asset watch accounts. Before we understand this terminology, and before I tell you what RBI, what regulators, what people, what management expected from us, let's understand the basic of banking. We're not going to in depth to understand the basic of banking products and the prudential norm, because we're gonna have different session altogether where we'll discuss the entire banking, the prudential norm in detail. So let's start with the products. So predominantly banking has 2 types of product. The funded facility, and the second one is non-funded facility. Now what are the funded facilities? Funded facilities are those facilities which are lying at the asset side of the balance sheet, which means it's a part of your balance sheet. What are the non-funded facilities? Non-funded facilities are which is not a part of assets, but it's actually the facility given to the customers. There is a separate disclosure, though it's not a part of balance sheet, but the separate disclosure is given for that. What are the examples? What are the examples of funded and non-funded? The funded facilities are cash credit, overdraft, export credit, packing credit, pre-shipment, post-shipment, so-called term loans, working capital. These are the types of funded facilities. What are the non-fund facilities? Like a bank guarantee, letter of credit, counter bank guarantee. These are the different non-fund products. We will discuss some of the key products, because this is very important to understand the meaning, the difference between the products which look similar, which has a similar analogy, the meaning, the characteristic is similar, but the classification of NPA differs. So let's understand what are those products. Cash credit and working capital. Cash credit, working capital, both are working capital facility, but the overdraft is a facility wherein you can actually withdraw in excess of your balance. But the CC is like the different facility altogether. For CC you need to have a different account. It's a separate loan account, and the limit is given to the bank. In case of CC, the interest is being charged on the basis of amount availed. But in case of overdraft, the interest is being charged on the basis of daily outstanding balances. So that's the difference between the two. Then we have export credit being given to the exporters. We have letter of credit which is given to the importer. Then the bill purchase and discounts. Again, this is quite interesting. A borrower needs, a trader needs, a manufacturer needs a credit. What he can do is he actually come and discount his bill and get the credit. It's again a part of funded facility. Buyer's credit, again the buyer's credit is given to the importers. And the guarantees, bank guarantees. What are the different types of bank guarantee? We have a financial guarantee, we have a performance guarantee, we have a deferred payment guarantees. Again, these are the non-fund facilities. Now let's understand securities. What are the securities? What kind of security a borrower can have while taking the loan? One is the primary security. In banking terminology, they call it as a primary and the secondary. Primary security is a security where the bankers has a primary charge on those security, and the secondary security is like a quasi security where the multiple banks can have a pari passu charge on that same security. So that's the classification of security. Next is the type of security. What kind of security you can have? One, the security, the loan could be a secured or unsecured. Secured means actually backed by the physical security. It could be a movable property or it could be a immovable property. Please understand the security, because the type of security, the valuation of security actually impact the classification of loans. And I'll tell you why, and I'll prove you how the value of security actually make the account NPA. Not only NPA, it straight away put the account into doubtful or a loss category depending upon the erosion of the value. And I'm sure you'll be surprised to know that. What are the different modes of creating security? The first one is mortgage. Mortgage where the physical asset doesn't go to the lender. How it works is, it's like a home loan. You don't actually transfer the property to the bankers, you transfer the interest, the title of the property to the lender. And the possession is being with the borrower. The second category is pledge. It's unlike mortgage where the legal title remains with the borrower. Borrower just transfer the property to the lender. So that's the pledge. And the third one is hypothecation. Hypothecation, neither the interest in the property nor the physical goods transfer to the lender. It's an equitable charge on the property. The fourth category is a set-off. Set-off is a right of bank to adjust deposit with the loans. So they can set off debit balances with the credit balances and vice versa. The fifth category is lien. Bank has a right to retain or to hold the assets and the securities of the borrower until he pays off entire loan. So that's a type of security a borrower can create. Now let's understand prudential norms. What are those prudential norms? Before we start prudential norm, let's understand the type of borrower a bank can have and what are the prudential norms applicable on the borrower or their exposure, or maybe a borrower is actually working in a group. For example, Tata Sons is an individual entity, but Tata as a group has a multiple organization, multiple industry, multiple companies like Tata Finance, Tata Motors. So RBI has given a guidelines. What it says, a bank can have a exposure with a single party to the extent of 20% of their capital base. Now what is a capital base? Capital base is nothing but the tier 1 capital computed as per Basel III norms. So it says if there is exposure to the single party, the exposure cannot exceed 20% of the capital base, and if it is to the group, the exposure cannot exceed 25% of the capital base. Recently RBI has come up with the regulation on it called Large Exposure Framework. They issued this circular during December 16. I'll put the link below in the description. Please subscribe to this channel and click on the bell icon, because we are going to give you a notification as and when RBI come up with a recent amendment, circulars or any update in the banking. We will update you, but for that you need to click on the bell icon. Plus, if you have any comment, any clarification, please write it below and we'll try to answer them. Further, it's very important to understand what kind of loan a borrower can have. What are the arrangement he can have with the banking system? The very first is sole banking. Sole banking means what? He can have all the credit facility with one single bank. Be it export credit, term loan, working capital, he will have it only with a one bank. So that's a sole banking. The second type of arrangement is a consortium. Consortium is an arrangement where multiple banks come together and fulfill the borrower's requirement. The banks which has the highest exposure is considered as a lead bank, and the bank with the second highest exposure considered as a sub-lead bank. The third category is multiple banking. A borrower can walk into multiple banks and avail multiple facilities. That's called a multiple banking. And the fourth category is a loan syndication. Now what does that mean? There are investment bankers, there are advisors who actually scout the multiple banks who are willing to lend to a particular borrower. It is arranger's responsibility to have a documentation done on behalf of all the borrowers and the lenders. So that's a loan syndication. It's very important when you go through the credit, you will see this kind of arrangement. And it is very important to understand what is a syndication, what is a consortium, what is a sole banking, what is a multiple banking arrangement a borrower would have. Because that will actually impact the risk of the borrower. Let's understand very broad level what is a lending process and how the lending process, the various lending process impact the credit assessment. So what are the broad lending process? The one is the sourcing. The very first is the sourcing. Then comes appraisal. The third comes with the sanctioning. The fourth is disbursement. The fifth is monitoring. And the sixth one is recovery and the collection. Let's understand each of this process very high level and we'll move ahead. The sourcing, it is very important to understand. As an auditor, you should understand what is the source, what is the reference of this particular borrower, where these loans come from, whether this comes from internal sources or this is the existing customer or the new facility given to the existing customer or the existing group, or it has been sourced from the open market. So it is very important to understand what is the source. Then comes to appraisal. It is very important to auditor to note that the kind of documentation procured, obtained from the borrower, we need to actually see the cash flow. We need to actually see the financial statement. Sometimes I have seen the audit team is actually going to MCA 41, MCA website, and actually they pull out the financial statement of that particular borrower and they check whether those the fine financial match with the financial provided to the banks. It hardly takes 50-100 rupees to pull out that information from RBI website, but you have to do that. There will be a possibility that the financial there would be mismatch as compared to the file financial. Other than that, the financial statement, you need to see the cash flow. No matter how good the financial statement, how much profit they are making, but the borrower does not have visible cash flow, there is a challenge. You need to ask these questions to the management. Where is the positive cash flow? If a borrower does not have a positive cash flow, how are they going to pay? And this is what we discussed last year. I remember we had opportunity to meet RBI official, very senior official, and they actually discuss what is their expectation from the auditor, what is that they are looking out for, and what is they expect from the auditor. We are going to cover that, what is RBI wanted us to look at specifically in audit, not specific to the particular bank, but in general. And we'll discuss all of them. But you need to stay tuned till the end. Because before we discuss those terminology, those procedure, you need to understand basics of audit. And I'm sure this technique will definitely, this 30-45 minutes will definitely help you to understand the entire banking, the audit of advances very particularly. It will definitely help. And when you take this knowledge and go to bank, and when you start actually discussing these processes, the management will look at you differently. Because when you use this terminology, show me SMA 12012 account, show me PRILC, show me project under implementation, show me let's have a discussion on the stress assets under watch, or maybe watch list account, what are the red flags account, you will sound confident. And moment you sound confident, the management will look at you as a competent person, because you will no more asking the question which are not applicable. You are asking the relevant, subtle questions. You are actually touching the pain points of the borrower. And I'll give you surety for that. But the condition is you need to stay tuned till the end. The second process is sanctioning. But before sanctioning, the bank has to actually go through the financials of the borrower. They need to see various ratios, debt equity, stock to sale, ROA, various ratios they will actually calculate. And the basis of that, their qualitative assessment and the quantitative. The quantitatives are ratio analysis, number, and the qualitative analysis are the industry which borrower belongs to, what are the risks, what are the environmental risks, regulatory risks, internal risks, external risks associated with that borrower. They combine both aspects, the qualitative and the quantitative analysis, and they'll give their own rating. It could be a numeric, it could be alphabetic, it could be a alphanumeric. It need not have to be a rating what the external rating agency would give. Each bank has their own algorithm, they have their own mechanism of giving internal credit rating to the borrower. So they will give that rating basis which they will give the limit to the borrower. Not only the limit, they will also determine the price of that particular product. Basis which they will get the approval, they will put the documents on record and they will disburse the loan. Now you will think, now disbursement is done, now everything is over. Do I need to do anything after the disbursement? So my answer is yes. The real audit starts after the disbursement. Because monitoring is a very important aspect. You need to see the performance of the borrower. You need to see how frequently he defaults. You need to see how frequently he submits the stock statement, how frequently he gives the financial statement. It's very important. And there is a saying that loan is considered as NPA when it exceeds X number of days. And we'll discuss what is X number of days. But it is not only overdue days. There are other aspects. There are other irregularity which we are going to discuss shortly. It's not only overdue days, but it is also the other non-financial financial parameters which actually classify loan as a NPA. So we discuss the monitoring and the last one is the recovery and the collections. Let's move to Schedule 9. Now it's very important. The whole session is on advances, audit of advances, what are the documentation, what numbers to be checked in the financial statement. If we don't discuss Schedule 9, which is the loans and advances, it will be interesting, right? So Schedule 9 is your loan and advances. Again, Schedule 9 is divided into three parts. A, the nature of advances, whether it's a bill purchase, discount, cash credit, overdraft, term loan, so that comes under 9A, nature of advances. B is nature and extent of security, whether it's secured, unsecured. And the third one is place of security creation, whether it's within India or outside India, whether it is given to the priority sector or it is given to the banks or the public financial institution. And the residual category is others. So these are the three broad subsection fall under Schedule 9, Schedule 9 A, B, C. Now we will discuss the most important aspect of audit of advances, which is prudential norms. Here we will discuss what are the non-performing assets, what are the income recognition criteria, what are the asset classification norms, what are the provisioning norms. So what is NPA? You must have heard this term quite often, and I'm sure you all are aware of this, but today we are going to touch base some of the key definition, key aspect which beginner can use, and they will also understand the meaning of it. What is the definition of NPA? The loan become NPA when it remain overdue, when the customer does not pay due or the outstanding balance on the due date. It's become a non-performing. Non-performing means customer cease to pay and bank cease to generate revenue from the loan. And how would you identify NPA? It's very interesting and very important to know banks has a various product: CC, audit, term loan, securitization, derivatives, credit card. Different product has a different characteristics. So let's start with the term loan and the working capital. When the interest and the principal remain overdue more than 90 days, the account is considered as a non-performing assets. I repeat, when the principal or the interest remain overdue more than 90 days, it considered as a NPA. But it is not with the CCOD. In case of CCOD, the account remain out of order, and we'll discuss what is out of order shortly, but it is remain out of order, the account is considered as a NPA. In case of agriculture loan, and if it is a short duration crop, if the farmer, the agriculturers or the borrower does not pay for 2 crop season, the account to be considered as an NPA. If it is a long duration crop, if the borrower does not pay for 1 crop season, the account to be considered as an NPA. In case of credit cards, what is the credit card? You all have credit card. If the customer does not pay a minimum average due, minimum average due is nothing but the fraction of total outstanding, and bank has their own methodology. There are set procedure, the regulation to be applied while computing the minimum average balance, but in layman language, it's the fraction of total outstanding. If the minimum average due is not paid on time, or maybe it exceed over 90 days, the credit card considered as an NPA. Now here I have one questions. So before I start this session, we have discussed this case with the council members, the senior officials, senior members. in our fraternity, and we take the questions. The question here is, the first question here is, if a borrower has a huge loan, say loan of rupees 100 crore, a promoter has a loan of term loan of 100 crore, and he also have a corporate credit card, and the corporate credit card has a balance outstanding of say 5,000 rupees, where at the same time the promoter has a loan of worth of 100 CR. The question here is, if the promoter does not pay credit card EMI, credit card dues on time, and the credit card, the fraction of this, the total exposure become NPA, will that make the 100 crore as a NPA? So I'll repeat this question. For example, promoter has a two facility. One is a credit card and the another is a term loan of say 100 rupees. Now borrower does not pay credit card dues and it become NPA. Will that actually make the 100 crore as a NPA? Again, there is no yes or no answer, but if you follow the Prudential norm, the bare reading of the Prudential norm says once the account become NPA, the other facilities of the same borrower become NPA. There is a terminology called as once NPA, always NPA. And another question I have received here is whether the account to be classified as a borrower level or the account level. So it's very clear that account has to be classified, the NPA classification has to be done a borrower level, not at a customer level. For example, a borrower may have a two different accounts, say credit card, term loan and the export credit. He is paying all term loan and the export credit on time, but if he is not paying credit card dues, it will automatically make all the facilities of the same customer as NPA. So we answered two questions here. The one, whether the NPA should be considered as a borrower level or account level. Yes, it has to be done at borrower level. And if one account become NPA, the other facilities of the same borrower has to become NPA. Now we say, what is out of order? Out of order, the term is used for CCOD accounts. What is out of order? In CCOD account, there is no due date, meaning the loans are payable on demand. So how does it work? In order to have or call this account out of order, we need to actually take the statement of account and we need to see whether there is a credit, sufficient credit in the CC account, CCOD account. So what does that mean? So there are three conditions to be understand. The one, if the customer does not pay, there is no credit for the period of 90 days. Yes, I repeat, there is no credit for the period of 90 days, the account is considered as out of order. Second condition is, there is a credit in the account, but the credit is not sufficient to cover the interest debited to the account. I repeat, the first condition, second condition look similar, but both are different. The first is, there is no credit at all. And the second, the credit is not more than the interest debited to the account. So that's second condition. The third condition is, the account, the outstanding balance exceed the limit given by the bank. So what does that mean? So your outstanding balances, borrower outstanding balances is in excess of the limit given. For example, the bank has given a limit of say 100 rupees and the customer has an outstanding balance of say 120. So if that 120 rupees remain in excess of the limit given for a period of 90 days, the account is considered as out of order and it straight away become NPA. So what needs to be done when the account become NPA? Of course, the first is a classification, second is a disclosure, and other than the making a statutory provision on this NPA account, the entire interest, entire income which bank has accrued, which they have not realized, have to be reversed. So I repeat, the entire income, interest income which the bank has accrued, which has not realized, has to be reversed. Now let's understand different types of NPAs or different types of advances. One, standard, the client or the borrower who is paying all the dues on time, he is not ceased to pay EMI interest, is considered as a standard asset. There is no incipient stress in the account, is considered as a standard asset. What are the substandard assets? Substandard assets are those assets who remain overdue, who remain NPA for a period less than 12 months. So they have given a time frame for substandard, doubtful 1, doubtful 2, doubtful 3 and the loss assets. The first category is substandard. If the account remain substandard NPA for a period less than and equal to 12 months, the account is substandard. Then comes doubtful. Again, in doubtful there are three categories. The first category is doubtful 1. If the account remain substandard or account remain NPA exceeding 12 months but less than 24 months, the account is considered as a doubtful 1. If the account remain NPA for more than 24 months but less than equal to 48 months, the account considered as a doubtful 2. And the doubtful 3 is a account, any account which remain NPA more than 48 months. It's a doubtful 3. And the last category is a loss asset. Loss assets are those assets which are not fully written off or maybe fully provided. It's fully provided but not written off, but identified either stat audit, internal auditor or maybe RBI. It's not only the bank who identify asset as a loss asset, but the external agency like statutory auditor, internal auditor, RBI can decide or identify asset as a loss asset. Now we discuss, very beginning of this session we discuss, it's not only days past dues. In banking terminology we call it as a DPD. It's not only DPD which determines the classification of loan as a NPA. Other than that, there are other criteria which actually determine, which actually classify loan as a NPA. What are those? Let's discuss. First we already discussed the value of security. If there is an erosion in the value of security, for example, realizable value of security falls below 50% of the value assessed by the bank. I repeat, if the realizable value of the security falls below 50% of the value assessed by the bank, the account has to be considered as a doubtful assets. Straight away it will go to doubtful. It will not first consider as a substandard, then doubtful 1, 2, 3. It will straight away go to doubtful category. We'll discuss what will the provisioning for the different category, but let's understand what are the different types in which account can become NPA. It's very important, very important. Very few people know this, and I want you all should know this. The second category is if the realizable value of any security falls below 10% of the outstanding balance. I repeat, falls below 10% of the outstanding balance, the account straight away should be considered as a loss asset. So we discussed two categories. Realizable value falls below 50% of the value assessed by the bank, considered as a doubtful. Realizable value of security falls below 10% of outstanding balance, considered as a loss asset. The third category is if the stock statement basis which bank has given CCOD facility, if the stock statement is older than 180 days, the account should be considered as an NPA. there is a norms, there is a regulatory requirement that it is not only the appraisal, the renewal process, the review process, it should not be a one-time activity. It has to be conducted at a regular intervals. It could be a half yearly for some client, it could be a quarterly, it might have any frequency, any interval, but the date has to be determined the bank. If the account is not reviewed periodically, and if it is not renewed more than 180 days, the account should be considered as an NPA. Now again, these parameters are beyond what we discuss about days past dues. The another category is a fraud. Again, in fraud there are two different categories. One, a timely reported fraud, and not timely reported fraud. The first category is timely reported. If the bank timely report the fraudulent borrower, the bank has to make a provision over a period of 4 quarters. But if they don't, they have to make 100% provision on the month or the quarter itself, the quarter in which they report the fraud. So we discuss what are the different categories which actually impact the classification of loan. One, the security value. Second, the aging of the stock statement. Then the aging of the last review date, and the fourth one is fraud category. Let's understand what is a project under implementation. And it is very important. Lot of large banks actually have exposure to project under implementation. Large infrastructure project they have actually given the loan to. But before we start, we have a question here. Will the mismatch in liquidity actually impact operation of the bank? I will answer these questions along with the discussion on a PUI. Before we answer, let's understand the banking system. Before, banks like ICAI, HDFC, IDBI, IDFC, there used to be a bank called Development Finance Credit, and this bank typically used to give credit for industrial activity, for infrastructure activity, and they had a domain of giving loan to the large corporates or for a large project. Banks like nationalized commercial bank, they have actually nationalized to cater to help small farmer, individual retailer, SME segment, exporter. So they have actually nationalized to take care of the small time, a mid-size corporates. But what is happening in current market scenario here is, bank has a source of fund which is very short term. For example, bank has a CC, a CASA balance, they have a saving balance, they have a demand deposit, they have a saving deposit, which has a life of 3 to 4 years, or maximum 3-4 years. Whereas they actually started lending to the project, which has a tenure of 10 to 15 years. So there is a mismatch at the beginning. Bank has actually started giving loan for big infrastructure project which has a life of 10-15 years without realizing source of the funds. They have a source of the fund which has a life of a tenure of 3 to 4 years, but they have a asset which has a tenure of 10 to 15 years. India has a funds like LIC, PF, pension. There are various funds India has which are the long term in nature. The source has a long term repayment schedule, but their charter does not allow them to fund large project. So that's a gap in the Indian economy, that the banking system actually don't know where to fund, and if they fund, what should be the sources of the fund. The entire system, I'm not saying they have done it with a malicious reason, but this is because this is on account of lack of understanding. And this is where it is very important to understand what is a project under implementation. What kind of project come under project under implementation? And lot of large projects like a road project, infrastructure project are on hold on account of multiple approvals, the state approvals, central approvals, environment approvals, agriculture, non-agriculture land dispute. So it's very important. The project under implementation have a two different kind of products. One is infrastructure products and the another one is non-infra product. In order to understand audit this area, we need to understand what is a DCCO. The DCCO stands for date of commencement of commercial operation of the project. At the beginning of the appraisal, the borrower actually gives the date of commencement of their commercial operation, and we have to actually look through what is the DCCO. If the DCCO extend, because a lot of project they are not able to complete the project on time, if the borrower extend their DCCO and the extended DCCO is within 2 years for infrastructure project, it is not considered as a restructuring. But if it exceed beyond 2 years from the original date of DCCO, it is considered as the restructuring, and the restructuring norms, regulation, accelerated provision will be applicable. So as an auditor, I urge all the team members to look at the DCCO and the revised date of the DCCO. For infrastructure, if it extend 2 years, it will be considered as a restructure. For non-infra, it extend 1 year after the original DCCO date, it will be considered a restructure. So it's very important. You need to call for list of project under implementation from the branch, or if you're a central auditor, you need to call this information from the management. And management might say this report is not available readily with us. There is a RBI requirement. There is a return to be filed with the RBI on project under implementation. So when you tell them that give me access to those return, they will be able to give you this information. But you need to ask this question. If you want, you can note down this few important points. It will definitely help. And anyways, I'm keeping the summary of this session, the important links to the circular down below in the description. So what are the provisioning requirement? If the loan account is substandard, the provisioning percentage is 15% on the secure portion and 25% on unsecured portion. If the loan is doubtful 1, the provisioning requirement is 25% on the secured and the 100% on unsecured. If the loan is doubtful 2 category, the provisioning norm is 40% on the secured, 100% on unsecured. If it is a 3, it's straight away 100%. And then in case of loss asset, it could be 100% provision or it could be completely written off. I repeat, how to remember this provision. So the shortcut is 15, 25, 40, 100. So 15 is for substandard, for doubtful is 25, doubtful 2 40, and the doubtful 3 is 100. 25, 40, 100. This is how we remember this. Now understand another important aspect, valuation of security. We discuss value of security is actually impact the classification of loan. But what is the frequency of valuation of security? If the loan amount exceed 5 crore, there should be an annual stock audit. The bank has to conduct the stock audit annually if the exposure exceed 5 crore. And in case of immovable property, the valuation has to be done once in 3 years. Again, bank can have a valuation or auditor can demand for a valuation report annual basis or for the reporting period, but this is a statutory requirement for NPAs. Again, we discuss exposure to the borrower. What is exposure? What exposure is a summation of all the credit facility, whether it's a funded, non-funded, derivatives, liquidity facility, credit card. It's summation of all the facilities, potential equity exposure. It is summation of all the facilities. There is a separate circular on the exposure norm. I'll put the link below in the description. Please click on the icon below so that we can send you the notification. We can send you the various new circular, new amendment on the banking and BFCs. Now understand, we discussed the provisioning requirement for substandard asset, doubtful 1, 2, 3. Let's understand provisioning requirement for the standard assets. If the loan is given to the agriculture, allied activities, SME segment, small service provider, there is a category given for this particular category. If it is for agriculture and allied activity, the provisioning percentage is 0.25%. If it is given to the CRE stands for commercial real estate, the provisioning percentage is 1%. And if it is for CRE-RH, commercial real estate for residential housing, the percentage is 75%. And other than any other category other than the category we discussed before, the percentage is 0.04%. It's a 0.40%. These are the provisioning requirement for standard assets. Let's understand and this is very important to understand in today's economy, when the corona is everywhere, the global economy is down, there is a huge exposure. Our borrower, Indian borrower, has already taken a huge borrower on foreign companies. They have overseas exposure. So this terminology is very important, called UFCE, unhedged foreign currency exposure. If your customer has any exposure to foreign currency and which is not hedged, you need to pull out those cases. RBI mandates to make a provision on those cases. Now the provisioning requirement and the computation methodology is given in the circular. I'm putting a link below in the description. So they have given, there are circular which RBI has issued in January 14 and the June 14, and they have actually given the methodology of computing provision. The provision ranges from 0% to 80 bips. 0 bips to 80 bips. But for that you need to understand what are the customers, what are the borrowers who has a foreign currency exposure. Again, if this information is not available with you, what you can do is, on sample basis, you can pull out borrowers' financials, and there is a requirement to disclose foreign currency exposure in the notes to account. You can actually look into the notes to accounts of the financial statement and understand whether the borrower has a foreign currency exposure, yes or no. If they have, then you need to have this provision, which is mandated by RBI. You can note down some of these key important points. Let's discuss what is a GNPA, what is NNPA, and what is a PCR, and how the standard asset provisioning and the NPA provisioning would be considered while computing this ratio. Let's understand provision coverage ratio. Provision coverage ratio is a percentage of provision on the loans. For example, if the loan become NPA and banks make 15% provision, the PCR is 15%. But the catch here is another question I have received here is whether the standard asset provisioning to be considered as a part of PCR or NNPA. So answer is no. The standard asset provisioning need not to be considered or netted out from the loans. It has to be categorically separately disclosed as a contingent provision in Schedule 5, liabilities and provision. Whereas NPA provision has to be netted off or may be netted off from the loans in Schedule 9 itself, which will be a part of net NPAs. Net NPAs it is nothing but the ratio of net NPAs to the net advances, And while computing net NPAs and net advances, you have to consider only NPA provisioning, not a standard asset provisioning. Please make a note of it. The another important aspect which I have already mentioned at the beginning of the session that we will discuss towards the end is SMAs. SMA account, special mention account. Actually, this terminology has actually caught the attention of a lot of regulators, a lot of agencies, a lot of auditors, be it internal, external. Very important to understand what is a SMA, what is the source, how a bank identify SMA account, where they do report. So SMA is further classified into SMA 0, 1, 2. The SMA 0 is any account whose DPD exceed more than 0. So in layman language, if the DPD ranges from 1 up to 30, 1 to less than or equal to 30, the account is considered as a SMA 0. SMA 1, if DPD exceed 30 but less than equal to 60, the account is considered as SMA 1. And the SMA 2, and the key area of banking or key area for auditor to look at is SMA 2, where the DPD exceeds 60 days but it is less than equal to 90 days. And anything beyond 90 days is NPA. So as an auditor, you need to ensure what are the NPAs, what are the SMAs account. It is very important to have an analysis of SMAs account. What as a part of audit team, what I used to do is I used to pull out a monthly SMA list and actually pull out SMA 2 accounts, and actually used to see the trend of SMA 2, whether the SMA 2 remain SMA 2 over a period of 6 months, 8 months, 9 months, yes or no, because it's impossible to remain a account in SMA 2 category for a longer period unless he's paying only one EMI, keeping 2 EMI outstanding. And these are the fraud prone cases, these are the suspicious cases. You need to actually take these cases out and ask the questions to the management, how are he paying only one EMI and keeping 2 EMI outstanding. So this is the area for audit. You can note down, you need to take list of SMA. Again, if the management is saying we don't have this, we don't have a data on historical information, what you can do is there is a regulatory requirement. RBI has recently issued a circular on the reporting of SMAs. Earlier, the SMA has to be reported on a quarterly basis, but now they have mandated to report. The return has to be filed monthly basis. I repeat, the return has to be filed monthly basis, and the individual borrower level information has to be reported on a weekly basis. So what does reporting means? Where does it go and how does it known to the bankers? So what RBI says is when the account become SMA 0, 1, 2, specifically SMA 2, bank has to inform this information to CRILC. The CRILC stand for CRILC, Central Repository on Information of Large Corporates. So it's a different portal altogether where individual banks submit information on SMA 0, 1, 2 to the RBI, and in return RBI disseminate this information, spread this information to all other banks who has exposure with this particular bank or particular borrower. What does that mean? For example, say a Bank of India has a borrower who has turned SMA 2. The Bank of Baroda will immediately inform RBI through CRILC, and RBI in return take this information and look into their database and will pull out the list of banks who has exposure with this particular borrower, and they will disseminate this information to all the bankers who has exposure, which helps other lenders to take a corrective action plan on the real time basis. So the process here is once account turns NPA, RBI mandate, RBI guide all the lenders to come together and understand what are the incipient stress in the borrower. If there are stress, try to understand how we can mitigate those temporary state, come up with the corrective action plan, the mitigation plan, and bring this account to the regular. So it's very important, you need to call for SMS 012 information. If bank is not giving the information, you can ask them give you the returns plus the weekly reports which they file with the CRILC. Very important. Now we'll discuss some of the key aspects of audits. What are the different process we need to actually undergo, and this is completely different from the conventional practice. Of course, you have to do those conventional audit procedure like test of control, sample of 25, depending upon the population, the size, your methodology, materiality, you need to select sample. The test of control is mandatory. There is no excuse. You have to perform the basic audit procedure, substantive audit procedure, primary substantive audit procedure, secondary substantive audit procedure, balance confirmation, if required site visits. I am not sure how this coronavirus thing, how are you going to actually visit site, have a physical verification. But what I urge is, and definitely institute may come up with the alternative procedure for the balance confirmation. They have actually issued a circular, the treatment or the impact of corona on audit. Maybe sometime soon they will come up with another guidelines how to have an audit done for this particular area. But this whole corona pandemic going to impact our audit process, and we need to be very, very careful. I have a question received. The question is whether the corona will impact our audit procedure or the classification of loan. So to answer this question, though the RBI has come up with the plan, the leeway, the extension, but it's all prospective. But the today's stress in the market, in the borrower, is not the stress which it's created today itself. It's an accumulation of stress over last few months. So we need to you need to take cognizance of that. There are industries which are hugely impacted by COVID-19. What are those industries? The industries like hospitality, travel, retail industry, food industry, hotels are highly impacted. You need to take cognizance of those cases. You need to actually look into your loan list of loans, whether the particular branch, the bank has exposure to this unit. And you can further analyze, you need to look through what is the subsequent event post 31st of March, what is the current situation. Though the RBI has given the leeway, the extension, but we have to take a cognizance of it because the stress is there as on 31st of March. I'm sure institute and the RBI will come up with the plan, but you have to take a cognizance of it. You need to report those cases of incipient stress in your audit committee, in your if it is MOC, you need to put it in a MOC, LFAR, long form audit report, or any other reporting framework available with you. But you need to document those cases because the measures taken by RBI are all prospective, not a retrospective, and we are going to audit 31st March. The further, as we discussed, we had a discussion last year with RBI senior officials. We also had discussion with a lot of senior officials in the big consulting firm to discuss how we can actually, as an auditor, we can mitigate our risk. And I'm sure people are watching there whom I have discussed these cases. So we come up with the alternative procedure. We have come up with the something which is beyond our conventional audit procedure. What are those? And RBI regulator also expect us to do audit beyond what is mentioned in the circular. They want us to have out of box approach. And what does that mean? So RBI is very categorically expect from the auditor to look into restructure account. Now it is very important to understand what is restructuring and what could be the repercussion of restructuring on the normal classification. I'm sure you all are aware of what is restructuring, but if you look at restructuring agreement is subject to lot of fulfillment of conditions. There are conditions, there is a due date, there is a deadline, there is a performance of particular borrower to be considered. It's not only the auditor, as an auditor, you not only have to take cognizance of restructuring, but you need to actually look through what are the different conditions, what are the due dates, what are the performance of that particular borrower, and that has been fulfilled on time or not. You need to take a cognizance of that. RBI also mentioned, the regulator also expects us to look at the classification of restructure account, whether the banks make accelerated provision on that or not. There is a requirement in case of restructure assets, the bank has to make accelerated provision of 5%. It is there in the IRAC circular. I will keep the link below in the description. So need to look into restructure account. There is a separate disclosure for restructure account in notes to account. You need to look into it. This is a very important area. You may note down restructure account, the classification, upgradation of restructure account. Second is upgradation of NPAs. You need to understand very, very carefully when the banks upgrade a NPA or substandard account to a regular account, because there is a terminology called once NPA always NPA, meaning if once account turn NPA, in order to become that account as a regular account, borrower has to clear all his outstanding dues. For example, if a borrower has outstanding of 5 lakhs rupees and his DPD is say 91 days, in order to become that account as a regular account, he has to pay off the entire outstanding dues, and the DPDs for that account has to be a 0. For example, if a customer has a 91 days as a DPD, means he has not paid 3 EMIs, and the subsequent month, as on 31st March, he pays 1 EMI and his DPD become a 60 days. Will you classify this account as a standard? So answer is no, because the circular says until the account is completely regularized, meaning the customer pays all 3 EMIs, the account has to be still considered as a NPA. It might be customer might have a DPD of 15 days, 20 days, 25 days, or maybe 30 days, but still account to be considered as NPA. So we need to actually check what is the process when bank actually upgrade, what is the evidence, what is the recovery, what is the collection evidence they have. The second question I have come here is from the audience is, what is the effective date of NPAs? Now as an auditor, it is very important you to look into it. For example, if a particular bank is classifying account as an NPA, you need to actually look into it. You need not have to satisfy yourself, okay, the bank has classified account as a NPA as on 31st of March. You need to actually deep dive. As I already discussed, if the customer has a NPA as a DPD of 91 days on 31st of January, and he repays 2 installment during February, and again he does not pay 1 EMI in March. So you need to go through the first date when it actually hit the DPD of 91 days, and that will be the effective date. And why effective date is important? Because your substandard, doubtful 1, 2, 3 classification is depending upon date of overdue. So for example, it might possible that the bank has considered NPA late, but the effective date of NPA might be a long back. So you need to pull out those cases. You need to look through the effective date of NPAs. The third question is end use of fund. Now this is very important. We have heard the terms called evergreening, diversion, round tripping. It's all evolved around the end use of a fund. Now it's very difficult, very subjective to determine or to certify, to ensure end use of the fund. What is the procedure do you follow? And this is a regulatory requirement, and also regulator expect us to look into this matter. Very, very important. You can note down this. and you will ensure, you need to have a document to ensure end use of fund. If we don't have document evidencing end use of fund, it will be considered as negligence, that auditor has not performed sufficient procedure to ensure there is a diversion of fund. So what we need to do is, we need to actually call for the information. We need to actually look into, so how the bank, you need to understand how the bank ensure end use of fund, what kind of certificates they obtain from their statutory auditor, what are the certificate underwriting they obtain from the management of the borrower. We need to look into it. We need to actually see. Sometimes I have seen, we have mentor, we have actually guided our audit team to actually look into, for example, if one builder takes the loan from the borrower, actually you need to Google through and you need to look through the sanction letter for which project he has availed this loan. We ask our team member to Google the name of this project, whether there is a project lying there or not. If it is not, then we need to ask, this project has actually never started, even the plinth has not constructed. How can, what is the, why have we funded a loan to this particular person? You need to ask these questions, because there is a scenario, there are the names in the news, all over news, that the borrower is misusing the fund, they are actually siphoning the fund, they are actually diverting the fund from the main purpose. So you need to understand whether, and this diversion may be used for round tripping and the evergreening, and you may never realize. So you need to, what you need to do is, either you can collect the evidence from the management, second you can actually do the physical verification, the site visit, you can Google, you can actually look through on the social media the existence of that particular borrower and the particular project, the end use. We already discussed SMS 012 and the CRILC. Now the another important aspect is a red flag account. Now if a bank identified any fraud activity in particular borrower, they can classify this account as a red flag account, and moment they flag it as a red flag, they have to report it to the same portal of CRILC. So what we can do is, we can call for the red flag account from the management. If they don't, what we can do is, we can actually log in, we can ask management to log into CRILC account, and we can call for this information, SMS 012 or red flag account. Again, red flag account is like it is a suspicious of the fraud prone account, and we need to actually look through whether this account would turn into NPA or would turn into fraud. If it is become fraud, then there is a provisioning requirement of 100%. So we need to call for that information. The another account is fraud account. Again, the bank has to inform this account to the RBI. We can call for return. Management straight away might say, see, all the times my experience is client give this information, but they take some time. But if they are taking some time, they don't know what is the source where they'll put this information, you need to tell them that, okay, go to the CRILC login, pull out this information and give it to us. Or maybe if they are not sharing this information on account of confidentiality, you can have your samples, go to them and ask them, I want to see the report for this particular samples. That's it. But you need to have this. Another important aspect is the early warning system. Now RBI has not mandated, but they have issued a guidelines to banks that you need to have some early warning systems. You need to have your watch list account. You need to have your under asset watch. So bank need not have to wait until account become NPA, because account become NPA after 90 days. But before that, there is a sign, there is a signals that account might turn NPA. There are various triggers like corona. It will impact the hospitality industry, the retail industry, travel agency. This is a early warning signal for this particular segment. So like this, they might have bank have their own early warning system for different borrower, for different sector and for different areas. We need to call for this information. What are the early warning signals you have for your borrowers? Whether there is a degradation, or maybe the rating of this particular customer has downgraded, you need to call for the information, and that will be a size of your sample. You need to select sample from them. The third one is you need to call for a watch list account or under asset watch. This is again very important area. These are the standard loans, but bank believe this account might turn NPA at any point in time in future, because the reason as discussed, Brexit, Corona, or maybe any other economic turn down. So you need to call for this information, and your sample should be from that areas. The list of willful defaulter, again there is a regulatory requirement to file the return. Willful defaulter are those borrower who has defaulted with the other banks. So what the process here is, the bank has to inform willful defaulter list to the regulators, and regulator gives the list of defaulter to the banks. So we need to call for those willful defaulter and ensure that those defaulter are not part of our loans. If it is a part of our loans, there is a different process, that the any additional facility given to the willful defaulter to be considered as a non-performing, and there is an accelerated provision to be made on those willful defaulter. You need to call for, please make a note down of this willful defaulter. Unhedged foreign currency exposure, accelerated provision, additional provisioning requirement we already discussed. PUI we already discussed. Now the new concept here is NCLT cases. Now those cases which are into IBPC or liquidation, or with NCLT for liquidation, you need to call for this information, and your sample should be from those cases, NCLT cases, because NCLT cases might be a standard cases, but as you all aware, if the company is going to liquidate, if the lenders are going to take a recovery action against the borrower, how they will be able to survive. So it is very important to take a list of those cases as well. Again, you need to call for list of low rated cases. It could be internally low rated or externally. You need to call for this information. If the bank has recently downgraded their internal rating of a particular borrower, you need to call for this information. You need to also see the external rating. If the external rating is double B, triple B, and triple A, double B below, you need to call for this information. Your sample should be from those low rated category, because it will actually help you to identify those potential cases of NPAs. Another audit procedure is you need to see the transition of NPAs. Lot of time I have seen that while doing comparison of previous year NPA to current year NPA, there are a lot of classification change. The standard account become NPA, which is fine. The NPA becomes standard, or doubtful 1 becomes substandard, or doubtful 3 become doubtful 1. It is impossible to become NPA or substandard asset to standard unless customer pays off entire loan. So it is very important. You need to identify those samples where there is a movement. You need to call for information. You need to understand reason for the movement. It's very important, and I'm sure you will find this is beyond the audit process. This is just a scrutiny of documents, and you will get a lot of points, issues for discussion. You can put them in your MOCs as well. Also, you need to see non-fund exposure while making the funded exposure. For example, I'll give you one example here. Recently, a lot of banks, NBFCs are in news. If the company is in stress or become NPA or in the verge of liquidation, it's not operating. You need not have to make provision only on the funded exposure, but you need to think through of a non-funded exposure. Because if the non-funded exposure like letter of credit or bank guarantee, if a borrower is not able to honor that transaction, if it is a financial guarantee or performance guarantee, if the borrower is not able to honor that transaction, bank has to honor that amount. Bank has to honor that transaction, and that could be a potential exposure on the bank financial statement. Again, there is no specific regulatory requirement, IRAC requirement to make a provision on non-fund facility, but we need to take cognizance of non-fund exposure. We need to have a discussion with the management. The due date for the performance of this contract is coming soon. How the borrower is going to honor this transaction. If they can't, we need to ask the question to the management, why aren't we making provision on that? Very important, non-funded exposure of potentially stress cases or maybe NPA cases. Linkages of today's world is very important to understand. Linkages of Indian borrower to foreign subsidiaries or holding company. Now because of the corona, everything is went on stuck. Everything is stuck down. All the global travel, foreign travels are shut. There are borrower who has a huge dependency on the foreign subsidiary and borrower. If you have any borrower who has a dependency on the foreign entity, you need to classify those cases, you need to list down those cases, and you need to see the potential stress and the potential impact on the business, and accordingly you need to make a provision on it. Securitization case, another interesting area. If your bank has a securitization, please understand true sale criteria. What are the compliances bank has ensured to have a true sale criteria? It's very important. You need to have all the documentation. You need to actually look through the liquidity facility. You need to actually look through the waterfall, the cash flow. If the assignee is not paying dues as per waterfall, you need to consider that transaction as an NPA or make the relevant provision on that. Other than that, you need to actually look into a lot of other documents, very simple documents you might not have considered, but I must tell you, these documents has actually helped bank regulate to reveal some of the largest fraud in the industry. I'm not saying small fraud, largest fraud and the scam in the industries. You need to have those reports on your record, or maybe summary of those reports. What are those reports? First, whistleblower policy or whistleblower reports. If there are any whistleblower, what are the management process to identify or action on it? You need to have list of all those whistleblower which has happened during the financial year. You need to see the customer complaints. A lot of time you will find the frauds, a lot of things which are happening in the banks through customer complaints. Then very important, which everyone miss out, is RBI inspection report. Sometimes RBI point out when they come for audit or inspection, they point out a lot of gaps in the system. They identify the loan accounts which are stressed, and they recommend auditor or management to have a provision. You cannot afford to miss RBI inspection report. You need to have a summary of RBI inspection report on your record. You can also see the internal auditor and concurrent auditor report. Sometimes, since we have a limitation on in terms of time, scope, the samples, we cannot go through all the samples 100%, but the internal concurrent auditor, they go through the samples. Their sample size is quite high, so you can go through their report. You can see what is their observation, what is their comments on particular cases, and you can actually have those cases as a part of your samples. I'm sure this will definitely help. You need to also see the MIS report of particular branch or bank, whether the MIS report, the monthly quarterly reporting which has to the board, whether it tallies with the financial statement, whether it tallies with the system reports. For example, I have seen a lot of times the loan dump, the loan listing of loan, the total of loan does not tie with the trial balance. There are manual adjustment. There are some adjustment entries passed after the report generated. You need to understand what are those manual adjustment entries. While you are doing JE's journal entries testing, you need to have this kind of adjustment on the record. Very important. And I'm sure you will find a lot of manual adjustment entries, high value adjustment entries. Other than, you need to call for valuation report. As I already mentioned, the valuation report of securities actually impact the classification of loan. You need to see if the loan is standard, but there is a sectoral stress or the regulatory stress on a particular segment. You need to make a additional ad hoc provision. RBI doesn't stop you from making additional provision if you believe that there is an incipient stress in the portfolio. You need to also see through the impairment provisioning on the basis of security valuation. Also, what you can do is, RBI has already brought out 12 cases. Other than that, there are certain cases, certain banks, certain industries which are in news. If you have exposure, if the bank has exposure, that those cases needs to be part of your samples. I will not take a specific name. I don't recommend any specific name or borrower, but you can Google the stress industry, stress client, stress sector like oil, gas, steel, coal, road project, infrastructure. Well, they are all in stress. And now with coronavirus, hospitality, retail, travel, this sector are very much in stress. You need to actually look into those reports as well. Other than that, you can actually call for various report which bank use for RBI reporting purpose and the internal reporting purpose, like NPA, irregularity report. Irregularity report includes stock statement exceeding 180 days, non-renewal cases, erosion of security valuation, CCOD accounts, no credit in the CCOD accounts. There are a lot of other reports which are available with the bank. You need to call for. I'm saying I completely understand. I'm completely with you that it's very difficult to cover up all of them in a given time. But I'll tell you, out of my 9 years of experience working with the big 4 big consulting firm, management will never give you time. Nobody will give you a time. You have to actually take the time, their time out for your work. This is what I have learned last 9 years, that you have to take their time out. They will never give you time. It is like a snatching process. It's not a parliamentary civilized word, but you have to actually snatch the time from them. Then only you will be able to cover up this area. As regulatory, RBI expect us to go beyond a conventional audit process. These are the actual out of box audit procedure you have to perform. And I'm sure if you follow this, if you discuss these cases, management will provide this information, because they would not have come across any auditor, or maybe some of the very few auditor asking this kind of questions. So with that note, thank you so much. If you have any question, I'll leave my number below in the description box. You can call me anytime. If you are looking out for any other area, any other banking requirement, if your organization, your audit team is looking out for any other training, please note below in the description column, and we'll try to have a video on that, or maybe I can arrange a personal visit and come and give training on banking or any other area you are looking out for. Please subscribe to our channel and please hit on the bell icon. We'll send you a lot of notification, a lot of circulars. If you are auditor, if you are in this field, you should have hands-on RBI regulatory circulars, and will help you that. Please write your comment and share this video with your other colleagues who couldn't attend this seminar today. Thank you so much for being participative and asking a lot of questions, making a notes. Thank you so much. And once again, thank you so much, WIRC Chairman Mr. Lalit Bajaj, Regional Council Member Mr. Vimal Agarwal, Vasai Branch Chairman Ankit Rathi, Vice Chairman Abhishek Triwari. Thank you so much for inviting me here for this wonderful session. Thank you so much for all council member of Vasai Branch for coordinating with me and having this wonderful session. The coronavirus actually locked down everyone at home, but people like Ankit Rathi, Abhishek Tiwari, and all regional council member working for nation, working for members, they are doing every possible thing for all the members. I really appreciate the institute for these efforts. Thank you so much.